So apparently we did it. Canadian wages are finally outpacing inflation. The government says we are earning more than we are losing to price increases. Headline victory, right? But if you still feel like you're falling behind, your dollar stretches less and home ownership feels even further away, that's not in your head. It's in the math. Let's break down what's really happening with wages, inflation, home prices, and the money supply, and why it's not as rosy as it seems. Let's go. Stats Canada says average wages rose 4.8% year over year, with inflation set around 1.7%. On paper, that's a win. But averages can be misleading. Are you in an industry that's actually seeing wage growth? Do you live in a city where housing or rent is still skyrocketing? Has your disposable income really increased? If you are not feeling that 3% gap in your wallet, it might be because real expenses outpace CPI. According to Better Dwelling, Canadian home prices have climbed 7 times faster than income growth over the last 2 decades. Think about that. You get a 5% raise, your dream home goes up by 20%. Even if your wages grow faster than inflation, they're still not growing faster than asset prices. And that is the problem. This disconnect makes housing less affordable even when inflation cools. Here is where it gets really interesting. Inflation is measured in terms of CPI, which excludes asset prices like real estate and underweights things like food and rent. But look at M2 money supply in Canada. According to this chart, it's growing at 6.3% annually. That means there is 6.3% more money sloshing around the economy, but only 1.7% CPI? So either we are underreporting inflation or that excess money is showing up in asset inflation like housing, stocks, and everything you want to buy. This is currency debasement, not just inflation. Let's zoom out for a second. Visual Capitalist recently charted the US dollar against other major currencies. The USD remains strong globally, but it is showing signs of fatigue recently. If the US dollar weakens, it can drive up the commodity prices, which are priced in US dollar. And that inflation gets imported back into Canada, even if the loonie stays stable. This is why global currency moves matter locally. You cannot insulate your economy from international money printing or trade policy. So here is the macro reality. Your wages might be up, but your housing costs are way up. Your savings lose value due to money supply expansion. And global currencies are shifting in ways you cannot control. The result? A quiet squeeze on middle-class Canadians who think they are doing fine, but wonder why they cannot get ahead. If you want to learn how to make sense of this beyond the headlines, check out my macro fundamental course. It is built to help everyday Canadians like you and I understand the forces shaping their economy and money. Link in the description below. And if you want to talk strategy with people who see through the noise, join my WhatsApp community. No hype, just real world macro in smarter investing. Link in the description below as well. On that note, hit the like button, subscribe to the channel, and send this to someone who thinks a 5% raise means we are all winning. See you in the next one. I just wanted to let you know that I also offer one-on-one consulting calls to the individuals who are looking to discuss their financial planning, their investment strategies, their kids' education planning, their immigration moves, as well as the young professionals, because I have been in the tech industry for almost 20 years. So I also offer one-on-one consulting calls to the young professionals who are looking to have their career development discussion with me, and also personal branding as well. So if you are looking to have some sort of an expert opinion, there is a calendar link in the description below. Book a 30 minutes call with me and I will be more than happy to help you out.